Hello everyone, I'm Namrata Arora and welcome back to another episode in the Basics of Mutual Fund series. In the previous episode, we spoke about hybrid funds. Today in this video, we're going to talk about the different charges and the taxation involved in mutual funds. Now, as an investor, I'm sure all of you agree that we need to know what are the different charges involved while we're investing in a mutual fund. Now, for handling your money, every scheme incurs certain expenses. Now, what are some of those expenses? So they could be the brokerages which are paid to the stockbrokers for buying and selling shares. They could be the charges which are paid to intermediaries like the custodians, registrar and transfer agents, auditors, etc. Or they could just be the cost involved in communication to the investors. Now it is the investors who have to bear these expenses. So the question is, how much can a mutual fund scheme charge to its investors? Is it one time in nature, or do they charge these expenses on a regular basis? So let's understand what are the different types of charges that are involved. So broadly, there are two categories. First category is the one-time charges, and under the one-time charges, first is entry load. Now entry load is basically levied every time an investor purchases mutual fund units. But entry loads in India are banned and mutual fund schemes cannot charge entry loads. The next category of one-time charges is exit load. So exit load is basically a one-time charge that's charged to an investor at the time of redemption or switch out from a particular mutual fund scheme. Now exit loads are not the same across all the schemes. They vary depending on which scheme the investor has invested in. Now the current practice for exit load is that a fund would charge an exit load to an investor if the investor exits before a particular specified period. If the investor continues to hold the investment beyond the stipulated time period, then there is no exit load. Now let's take an example of an equity fund, say where the NAV is 50 rupees and the exit load which is charged is 1% if the redemption is made within 1 year from the time of investment. Now let's say that this investor chooses to redeem money within 1 year. So the applicable NAV for him in this particular case would be 49.5 rupees. Which means by exiting early, the investor is losing out on 0.5 rupees per unit. Now this money which is collected in the form of exit load is not supposed to be paid out as commission or used up for expenses. This money has to be reinvested back into the fund. So that basically means that the exit load benefits the existing investors who've chosen to remain invested in the fund. So think of it as a tool to discourage investors from an early exit from a particular scheme. Now, as per the illustration, if the investor chose to take out the money after 1 year, there would be no exit load charged to him. Next, what we're going to look at are the recurring charges which a mutual fund scheme charges to an investor. So recurring charges are also the ongoing charges or ongoing expenses, fund running expenses we call them, or they are also referred to as the total expense ratio or TER. Now, what are some of the expenses which are there on a recurring basis for a mutual fund scheme? So they could be sales and marketing expenses or fund running expenses, fund administration charges. They could be investment management charges or, the fees which are paid to different intermediaries. All these expenses are charged to a mutual fund as an expense ratio. SEBI has defined very clear guidelines in terms of how much a fund can charge as expense ratio, and no fund can charge beyond the expense ratio defined. The maximum that an equity-oriented scheme can charge as expense ratio is 2.25%. A debt scheme can charge a maximum of 2%, whereas if you look at passive funds like index funds or ETF funds, they can charge a maximum of 1% of the AUM as expense ratio. Now all these are annual numbers. As the size of the fund or the assets under management starts going up, the expense ratio charged by the fund starts coming down, which means the funds with higher AUM would charge less expense ratio. The expense ratio would have a bearing on the returns which are generated by the scheme. A higher expense ratio would mean lower returns generated by a particular fund. So expense ratios play a very significant role, especially in debt funds, because the returns generated by debt funds are relatively lower as compared to equity funds. And which is why it is very important to consider expense ratio while selecting a debt fund. The expenses are deducted on a daily basis from the net assets of the fund, and the NAV of the fund is basically calculated after adjusting these expenses. Also, there are multiple funds which want to focus on certain smaller locations in India, which is beyond the 30 cities of India. And for those cities or for those funds, an additional expense ratio of 0.3% is allowed over and above the specified TER limit. So you would see certain equity funds where the expense ratio is more than 2.25%, or you would see certain debt funds where the expense ratio is more than 2%. So now the next question is the total expense ratio same for all types of investors, or is there any form of differentiation involved? So all of us are familiar with the regular option and the direct option. So a regular option of investing in mutual fund is where a particular investor is investing in a scheme through a mutual fund distributor. Now in this case, the mutual fund house would have to pay commission to the distributor for selling the scheme to the investor. Now because the commission has to be paid to the distributor and these expenses are allowed to be charged to the fund as expenses, the expense ratio or the TER for the regular plan is going to be higher. Now, what is a direct option? Direct option is when an investor invests in a mutual fund scheme without any mutual fund distributor involved. So in this particular case, since the AMC doesn't have to pay any commission to the distributor, the expense ratio is on the lower side. So basically it means that the TER for direct option is lower than the TER for regular options. So if you see the example of large cap funds on the screen, you'll see the difference between the TERs under the regular option and the direct option. At the same time, as the fund size changes, you would see the difference in the regular and direct option as well. So for example, ICICI Blue Chip Fund has an AUM of about 31,000 crores and charges a TER of 1.69% under the regular option and 1.08% under the direct option. Compare that to Tata Large Cap Fund, which has an AUM of 1100 crores, where the fund charges a TER of 2.4% under the regular option and 1.66% under the direct option. So you as an investor, if you think you have a good understanding of mutual funds and have the knack of selecting the right fund for yourself, then you can go for the direct option and get the benefit of lower expense ratio, which can improve your returns. So other than the exit load and total expense ratio, there are two other charges which are charged to the investors. So first is your transaction charges. Now transaction charges are only applicable in case of purchase transactions under the regular mode, because in this case there's a particular transaction charge which is charged to an investor, and that particular fees is charged from the investment amount and paid to the distributor. So if you're a new first time investor in the mutual fund industry and you are creating your first mutual fund application, the transaction charges would be 150 rupees, and it is only applicable if your investment amount is more than 10,000 rupees. For existing investors, the transaction charges are 100 rupees per application, and again if the investment amount is more than 10,000 rupees. The applicable STT is 0.001% of the transaction value. Now, securities transaction tax is applicable on all equity mutual funds, all equity ETFs, equity hybrid funds, and balanced advantage funds. To sum up, as an investor in mutual funds, the charges that are applicable to you are exit load. So exit load changes from fund to fund, and there's no exit load charged if a particular investment is held for a stipulated time period. Next is your total expense ratio or TER. Now this is charged on a daily basis, and as the size of the fund increases, the expense ratio charge goes down and TER is lower for direct options. Next is your transaction charges, which is paid by an investor on a particular investment only in the regular options. And last, you have your securities transaction tax or STT, which is 0.001% of the transaction value only in the case of redemption of equity-oriented mutual funds. Now, let's look at the tax implication on investment in mutual funds. So there are two types of returns that an investor can earn from mutual funds. So first is your IDCW. IDCW stands for Income Distribution Cum Capital Withdrawal. Earlier, IDCW option was called as dividend option. So what is a dividend option? A dividend option is when the fund manager of a scheme chooses to book the profit and pass on the profit to the investor who have chosen that particular option or the dividend option. Now in the dividend option, since a part of the profit is already paid out to the investor, the NAV is going to be lower as compared to the growth option. The dividends which are declared for the investors are taxable in the hands of the investor as income from other sources. And if the dividend which is declared is more than 5,000 rupees, a 10% TDS is cut by the mutual fund. The other form of returns is capital gains. Capital gains is nothing but an increase in the value of investment which is realized only at the time of redemption. Now, capital gains can be classified as short-term capital gains or long-term capital gains. Now, to understand the tax implication on capital gains, first what we need to understand is the different categories of mutual funds as per the Income Tax Act. So there are equity funds and there are non-equity funds. So equity funds, as per the definition, is any fund which invests at least 65% of the net assets of the fund in Indian listed equity shares or domestic companies directly. Any fund which does not fulfill this criteria is categorized as a non-equity fund. So for example, an equity fund of fund which invests the corpus in another mutual fund is categorized as a non-equity fund for the purpose of taxation because they are not investing in equity shares directly. Similarly, an international fund which invests in international equities is not categorized as an equity fund but is categorized as a non-equity fund because it is not investing in domestic equities. At the same time, since aggressive hybrid funds and balanced advantage funds aim to hold 65% of the portfolio in domestic equities, they are categorized as equity-oriented funds. Now, in the case of equity-oriented funds, if the holding period is less than 12 months or 1 year, it is categorized as short-term capital gains, and the applicable tax in case of short-term capital gains is 15%. At the same time, if the holding period in equities is more than 1 year, it is categorized as long-term capital gains, and the applicable tax is 10% over and above 1 lakh in the form of gains. So for example, if your gains are say 2 lakhs, then 1 lakh is exempted and on the remaining 1 lakh, you pay 10% as tax. So similarly, if for an investor, if the investor was to redeem funds over multiple years, he could claim that 1 lakh exemption every year. So if the investor was to withdraw or redeem funds over multiple years from an equity-oriented fund, he could claim that 1 lakh exemption every year. So in case of non-equity oriented funds, which could be your debt funds, international funds, conservative hybrid funds, if the holding period is less than 36 months, then it is categorized as short-term capital gains and it is taxed as per your tax slab. So for example, if the highest tax slab applicable for you is 20%, then you pay a flat 20% tax on your short-term capital gains in case of non-equity oriented funds. Now, if your holding period is for more than 36 months, then that is categorized as long-term capital gains in case of non-equity oriented funds, and the tax that you pay is 20% with indexation. Indexation is nothing but adjusting the purchase price for inflation. So on one side, we pay taxes on capital gains, but what if there are capital losses? Now, these capital losses can be adjusted against capital gains, and we call this as setting off. So for example, you've sold a mutual fund scheme at a capital loss of say 50,000 rupees, and you have another mutual fund scheme that you have sold at a capital gain of 75,000 rupees after redemption. So in this particular case, the capital loss of 50,000 rupees can be adjusted against the capital gains of 75,000 rupees, which means effectively you are only going to pay tax on the 25,000 rupees extra gain that you have made, and this is called as setting off of losses. So remember the 3 rules of setting off. Capital losses can only be set off against capital gains and not under any other heads of income. Short-term capital losses can be set off against short-term capital gains and long-term capital gains, whereas your long-term capital losses can only be set off against long-term capital gains. So I do hope you like this video and you understood everything about the charges which are charged in mutual funds and the taxes that you have to pay. In our next video, we're going to talk about the systematic transactions. So we're going to talk about SIPs, SWPs and STPs. If you've liked this video, do hit the like button, share it with everyone so that you don't miss out on any of the future videos. And if there's any topic that you want us to cover, please feel free to mention it in the comment section. Also, we've used certain examples in the video. Please don't take that as an advice or recommendation. Thank you so much.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.